Good afternoon, everyone. Thank you for joining today. My name is Meghan Leemon. I'm a partner with PilieroMazza in our government contracts practice. Today, we are going to be talking about joint venture eligibility. Just a quick refresher on requirements for government contractors, um, particularly given the uptick in use of joint ventures and the current shift towards more GWAC type vehicles, multiple award IDIQ vehicles. We anticipate that the use of joint ventures will just continue to increase. So today we're just going to be talking about kind of some refresher points on use of a joint venture and things along those lines. So thank you again for joining us. As I mentioned, my name is Meghan Leemon. I'm a partner in our government contracts group at PilieroMazza. I focus primarily on anything small business within the government contracting realm. I do a lot of work with just general compliance and advice and counsel related to any of SBA's socioeconomic small business programs. And much of my practice is focused on mentor protege and joint venture arrangements as well. I also assist clients in just general maintaining compliance with SBA's regulations, as well as the FAR, DFARS, et cetera. And also, if you happen to be undergoing any sort of transaction, I can assist with the recertification considerations that you need to keep in mind. Just a little bit quickly about our firm. We are a full service business law firm. We do focus primarily on government contractors, although not all of our clients are government contractors. We also do work with commercial businesses. In addition to government contracting, we have four other core practice groups: labor and employment, business and transactions, litigation, and construction. So today, and again, this is intended to be kind of a quick refresher. The goal or plan is to try to keep it around a 30-minute mark. So I will see what I can do to keep it within that time frame. If you have any questions as I go, feel free to input them into the questions box. I will try to answer them in real time, but if I can't get to them, I will take a look at the end to see what questions we may have. So today I'm going to go very high level in terms of what is a joint venture, what's referred to as the 2-year rule, and I'll explain what that is, whether or not you may need a mentor-protege agreement in order to do a joint venture, and then general compliance with SBA's joint venture regulations. What do you need? What are things to consider? And then lastly, we'll talk about the performance of work requirements. That's probably one of the biggest areas of questions I get on a pretty much daily basis. And then size and receipts and how joint ventures can impact your size and receipts. So at a high level, a joint venture is a limited purpose entity. I have SBA's definition here on the screen. As you can see, it's a joint venture is an association of companies coming together in any degree or proportion intending to gauge and carry out business ventures for joint profit over a 2-year period, but not continuing on a continuing or permanent basis. So it really is, in SBA's mind, this quote limited purpose entity. It is not coming together to form a new business that is going to exist in perpetuity and pursue, a ton of contracts over a long period of time. That would be more along the lines of a standalone entity. Here, for joint ventures, SBA limits joint ventures to 2 years. However, we often get a lot of questions of, okay, well, what does that 2-year period stem from? The date of formation of the company, the date we enter into an agreement. It's neither of those. So for purposes of the joint venture's lifespan, the joint venture may not technically start in the eyes of the SBA until it receives a contract. Once the joint venture receives its first contract, then you're on the clock. From there, you can submit additional offers for a period of 2 years from the date of first award. keep in mind that while that's the general easiest kind of rule to keep in mind, okay, I get my first contract award, I got 2 years, I'm good to go. Keep in mind that for purposes of this 2-year rule, the term contract refers to any federal prime contracts, novations of prime contracts. So if you have a contract novated to the joint venture, and subcontracts where the joint venture is treated as a similarly situated entity. So if another prime contractor is relying on the joint venture to meet its performance of work requirements, that does count for purposes of the 2-year rule. However, when I say contracts, I really do mean prime contracts. So orders under previously awarded contracts do not count for purposes of this 2-year rule. So I think that question just came in. You beat me to it. So orders, as I said, again, under previously awarded IDIQ contracts do not count for as new contracts for purposes of this 2-year rule. So you are permitted to bid on orders under an IDIQ long after the 2-year period has ended. The 2-year period focuses, again, on prime contracts, again, the contract, not the order, novations of prime contracts, and subcontracts where the JV is being used as a similarly situated entity. If you violate this rule, SBA will find that the joint ventures will be affiliated for purposes of determining the size of the joint venture going forward. It's not a general affiliation, which this potentially used to create under the old regulations. The key is that it impacts the size of the joint venture for purposes of bidding when that joint venture is being bid. We are getting a number of questions already in terms of will the slides be available. You can reach out to us separately for a copy of the slides. We can go to the next slide, please. So again, why are companies joint venturing? Why is this becoming such a big hot topic? Largely, and one of the biggest reasons for companies forming joint ventures is because it allows the government to look to the resources of each party in the joint venture that is going to perform the work. So a lot of times if the solicitation says, we will not consider the qualifications of a subcontractor. Now, there may be, as an aside, there may be ways to challenge that or push back. But if let's just assume that that is legitimate and a proper restriction under the solicitation. The same is not true in a joint venture. There is a rule that the government has to take into account and consider the past performance, experience, business systems, and certifications of all partners to the joint venture on set-aside contracts, in addition to any work that the JV itself may have done. We get a lot of questions about, okay, well, what does that really mean? And SBA has, over the last few years, tried to revise its regulations consistent with case law and so forth to further elaborate on what this means. So an agency can, but is not required to, require some level of past performance or experience from the protege itself. And this is specific to a protege. We can also get into this would also apply to like the 8A partner, the SWOSB partner. Maybe you're not doing a mentor protege joint venture. However, to the extent the agency is requiring some level of past performance or experience from the protege, the 8A, the SWSB, et cetera, the agency cannot require the qualifying company to individually meet the same evaluation or responsibility criteria. So the easiest example of that is, let's say, for example, the solicitation wants you to submit a past performance example with like $5 million, in the last annually, average 5 million annually. That may not ever be true, but let's just go with that. As it applies to a protege or an 8A company or so forth, the requirement would need to be reduced. So let's say maybe they would accept an average annual value of 2 million as opposed to 5 million. The requirement can still exist, but it does need to be reduced. The regulation goes on to provide that the partners in the joint venture in the aggregate, so like collectively, has to demonstrate the past performance, experience, et cetera, to perform the contract. So therefore, the agency should be looking at both partners, or maybe only one, depending on the needs of the agency. We get a lot of questions about joint ventures and facility clearances, and I think it's somewhat of a common misconception in terms of how this role works. So there may be a differencing of opinion depending on who you ask, if you're asking SBA, if you're asking DCSA, et cetera. But for purposes of this webinar, I'm going to go with what SBA says. So if each partner has a clearance, a facility clearance of the level needed for the work, that should generally be sufficient. However, we often get the question, oh, well, our mentor or our partner has a clearance. We can just use that, right? Maybe, not necessarily. SBA's regulations provide that if the facility clearance is required to perform the primary and vital requirements of the contract, then the qualifying partner to the joint venture has to hold the clearance. If it's ancillary, like it's just a part of the work, but is really not the key part of the work, then you could rely on the partner venture. So, okay, you've decided, all right, this all sounds good. Like, I want to go forth. How do I do this? So, a joint venture is a separate bidding entity. Then the question becomes, is the joint venture formed as a partnership, either an informal or formal partnership, a limited liability company, or a corporation? I would say 9.9 times out of 10, you're going with a limited liability company just for the added corporate protections. A partnership is possible. You do run the risk, though, of if there's something goes wrong, one of the joint venture partners needs to leave the joint venture, et cetera. You cannot technically have a legal partnership of one. So it requires a novation and so forth, and it can cause a number of issues in the process. Corporations also do not make any sense. I mean, given the requirements for like just the corporate structures, you also run into potential tax issues and things along those lines. So again, 9.9 times out of 10, I would say most companies are choosing to form a joint venture as an LLC. Some other considerations that you want to keep in mind is we get a lot of questions. Okay, well, does SBA have to approve my joint venture? And the answer is, generally speaking, no. However, that doesn't give any less credence to what you need to do in order to have a compliant joint venture. SBA approval is required before an award can be made on an 8A sole source contract to a joint venture. But other than that, SBA is not reviewing or approving joint ventures. We often get the comment, oh, well, I have a mentor-protege joint venture approved by SBA. You probably do not. You may have a mentor-protege agreement approved by SBA, but SBA doesn't and hasn't for a long time reviewed the actual contents of a joint venture agreement. Again, that doesn't mean that you can ignore the requirements. It's absolutely critical. It's just that SBA approval isn't required. Something else that is really important is that the joint venture, as I said, is a separate bidding entity. Therefore, the JV has to be registered and active in SAM before you can submit a proposal. So you want to make sure you're giving enough lead time to have the SAM registration set up and ready to go before you're submitting on a proposal using a joint venture. You cannot bid under like one name of one of the partners and then try to merge it to another later. If you want to bid using the joint venture, that entity, that bidding entity, needs to be registered and active in SAM before you submit your proposal. Another consideration is populated versus unpopulated. For a number of years now, SBA's regulations have provided that joint ventures have to be unpopulated, meaning the joint venture does not have its own employees. SBA has somewhat recently clarified that you can do a populated joint venture if each partner in the joint venture is similarly situated. So if you're doing like an 8A joint venture between two 8A companies, you could do a populated JV Keeping in mind, though, that the partners collectively to the joint venture need to be small if you're doing a populated joint venture. So that could be a reason in and of itself where this is a no-go. But generally speaking, most joint ventures are unpopulated. You could also do a populated JV for non-set-aside work. Um, so you could, that is possible, but for this presentation, I'm focusing on set-aside. The only caveat to this populated versus unpopulated is if you are seeking a facility clearance for the joint venture, which even though it may not be required, a lot of companies prefer to do just because it's easier. You can populate the joint venture with administrative personnel. So if you want to form the joint venture, one of the things you need to keep in mind is whether or not the joint venture will qualify as a small business. Again, most joint ventures are being formed to bid on set-aside work. So generally speaking, all members to the joint venture have to be small under the NAICE code that's assigned to the procurement that you are pursuing. It's not, you're not generically small, you're not generically large unless you're small under every single NAICE code or large under every single NAICE code. The key, though, is the NAICE code that's assigned to the procurement. So if both or all, because you could have a joint venture of more than two companies, are small, then you can go forth and go to the next step. However, if you're anticipating pursuing a procurement where one of the joint venture partners is not small, then the only way to do that and have the joint ventures qualify as small or whatever the applicable socioeconomic status is if the joint venture is between a protege and its SBA approved mentor. Keep in mind that mentor protege applications generally take about 90 to 110 days. In order for the joint venture to qualify as small, the mentor protege agreement has to be approved and in place prior to proposal submission. So if you need a mentor protege agreement because one of the partners is a large business, you need to make sure you have sufficient runway and lead time in order to do that. Otherwise, the joint venture is not eligible to bid as a small business. Just keep that in mind. That is important, and especially as you're doing kind of long-term planning on these, bigger IDIQs and GWACs. The majority owner of the joint venture, which would be the JV partner, so at least 51% owner, has to qualify for the type of set aside that you're going after. You cannot rely on the status of the partner venture. We'll sometimes get a question, my company is an 8A, I want to partner with an SWOSB company. Can we form a joint venture that qualifies as both 8A and SWOSB? The answer is no. There's a number of reasons for that, but number one is the qualifying party to the JV has to own 51%. You can't have two companies owning 51%. So you could potentially have two joint ventures, one where the 8A is the managing venture and one where the SWOSB is the managing venture, and you would have two different entities. But you cannot use the status of the partner venture to qualify then. So it has to be based on what the managing venture has. Before I jump to the next slide, I want to look to see, we had one question. We are an 8A certified. Another small business with no socioeconomic certs wants to form a joint venture. Do we need SBA approval? No, you do not. You only would need SBA approval if you are pursuing an 8A sole source contract, in which case the SBA approval is required. But to just perform it, to form the joint venture, no, you don't need SBA approval. To pursue competitive 8A work, no, you do not need SBA's approval. Another along those lines, for 8A competitive proposals with an approved mentor protege agreement, is JV approval needed? No. Again, 8A approval, SBA approval for the 8A joint venture is not needed, nor is it going to be provided unless there is an 8A sole source procurement. One question is, what is the SBA regulation regarding reference on the FCL of the JV? It's 13 CFR 121-103, I believe it's H. Okay, so moving along, given that we only have about 10 minutes left and I have some important things to cover. So, uh, joint venture compliance. Obviously, you want to make sure that if you're going to do a joint venture, forming the entity and having SAM is not sufficient. You need to make sure you have a compliant joint venture and operating agreement. If you're forming the entity as an LLC, you would need an operating agreement. Internally, we prefer to draft a combined joint venture and operating agreement, but they do not necessarily have to be a combined document. You could have a separate joint venture agreement and a separate operating agreement for the entity, or you could draft a combined document. I'm not going to go down through every single text of the regulation and what it requires, but there are a number of provisions that SBA requires be included in your joint venture agreement in order for the joint venture to be deemed compliant. Each regulation, and I have them listed here for 8A, small business, HUBZone, women-owned, and SDVSB. Each regulation has similar but not exactly the same requirements. Therefore, if you're drafting an agreement for a small business set aside, the requirements and what needs to be in your agreement are not the same as what's in the regulation, for example, for 8A joint ventures. So you cannot have a one size fits all joint venture agreement. You have to make sure it's compliant for the type of set aside that you are pursuing. The joint venture agreement has to be finalized and in place prior to proposal submission. If the solicitation allows and permits final proposal revisions, then the joint venture has to be eligible as of that date. However, you may not need to make revisions to your joint venture agreement if there's a final proposal revision. So the rule of practice is you need to have the agreement finalized in place, specific to the particular contract prior to the proposal submission. You also want to make sure that your joint venture agreement is in line with your proposal. If your joint venture agreement says that the responsible manager and the person in charge of contract performance is Bob, but your proposal clearly shows it's Sarah, there could be an issue there. And you want to make sure that the agreements you're not just drafting the agreement just to have a compliant agreement on its face. You need to be able to back it up through your proposal. Size and status protests are heavily related to joint venture compliance. I'm personally involved in a number of protests and appeals, even up to the Court of Federal Claims on joint venture agreements and whether or not they comply with the joint venture regulations. So one of the key items that you have to detail in the joint venture agreement is not that the company that qualifies for the joint venture has 51% ownership, but also that they manage and are controlling the joint venture. They have to be the managing venture. SBA's regulations require that the managing venture be responsible for controlling the day-to-day management and administration of the contract, but other partners in the joint venture can participate. So this is generally speaking where a lot of the compliance questions come up. Is the managing venture truly in control of the day-to-day management and administration of the contract? Are there certain controls that the partner venture has that are not permissible and go too far? Extraordinary actions like amending the joint venture agreement, pursuing different contracts, dissolving the joint venture, merging the company. Those are all sorts of things that the partner venture is permissible to have a say over. However, if any of the items are getting closer to the day-to-day performance of the contract, ultimately that needs to be managed and ultimately supervised by the managing venture and the responsible manager. That is probably one of the biggest areas for non-compliance that we see and is often the biggest negotiation point. And in addition to whether or not the joint venture is compliant as a managing venture, another thing that's required to be addressed for every single contract that the joint venture pursues is, are you detailing what equipment, facilities, and resources are required? And you can't just say, like, I don't know, we'll figure it out later. you have to be looking at the solicitation to see if the solicitation gives you enough information and details about what is if you could know what you need to provide. If the solicitation says you have to provide computers, desk space, things of that nature, then you should know and can address this in the joint venture agreement. You also want to make sure you're addressing negotiation of the contract. How are you staffing the contract? How are you going to perform the contract? Who is doing what? The qualifying party to the JV has to perform more than ministerial functions. They have to perform substantive work. Does your joint venture confirm that they are actually going to be performing substantive work? We'll typically take a look at the PWS, see what's in there, who's doing what. There's not necessarily like a right or wrong answer here because it's so specific to the requirements of the solicitation, but you want to make sure you're addressing like all of SBA's requirements for every single contract that you pursue. As you have a joint venture agreement, if you're pursuing additional contracts, you would then address each additional contract in an addendum, at least that's what I call it, an addendum to the joint venture agreement for those additional contracts. If you do not have a compliant joint venture agreement /or addendum, and if you're protested, you will more than likely lose the contract. So it's the joint venture agreement or the addendum is something that a lot of people don't give a lot of impact to. However, this is the absolute key document if you're bidding as a joint venture to prove your eligibility if and when there is a protest. Just to highlight quickly a couple of joint venture cases. So on the 2-year rule, this sides appeal of hometown veterans medical. Here, OHA found that there was a violation of the 2-year rule, even though the joint venture was awarded its first contract, but then it was terminated before it performed any work. OHA said that is not consistent with the plain language. So any contract award. We often get a question of, oh, my joint venture was awarded an IDIQ contract, but it doesn't start until I get my first task order, right? No, that is absolutely not correct. The contract starts the 2-year rule. Same for if you happen to have a contract terminated. And then to highlight the importance of needing to have the agreement in place before you submit your proposal, in size appeal of Colt Sunbelt Rentals, the parties had entered into a joint venture agreement, but it wasn't specific to the particular procurement that they were pursuing. They created an addendum, but they did it after proposals were submitted, and it wasn't signed. OHA said because it didn't exist as of the date to determine joint venture eligibility, it couldn't be used. And even if it could be used, which it couldn't because it wasn't signed until after proposal submission, it didn't contain all of the necessary detail of an addendum being specific to the joint venture, the project that the joint venture is pursuing. I cannot stress enough how important it is to have a compliant agreement or addendum before you submit your proposal. So just some best practices as you're drafting or reviewing a joint venture agreement and some items to consider. This is definitely not an exhaustive list, but things you need to pay attention for. Do you have an agreement or addendum prior to proposal submission? I know I said it a lot, but it's incredibly important. That said, you also want to make sure that you're addressing the solicitation specifically enough. If you have a draft solicitation, things can change between the draft and the final. You want to make sure you're doing your joint venture agreement at the right time, after solicitation issuance, but before proposal submission. Do you have, are there any control issues? Is the responsible manager for the contract identified by name, and is that person an employee of the managing venture? If not, do you have a signed letter of intent that you need to attach to the joint venture agreement? Is your joint venture agreement specific to the procurement that you're pursuing, or is it general? If it's general or if it's specific to another contract, do you have an addendum in place? Again, having the agreement for project-specific items for each project pursued is critical. And going back to kind of what we were talking about earlier, if the partner is large, is the venture protege agreement active and in place prior to proposal submission? And ensure all citations are to the appropriate set aside. As I mentioned, not every regulation is the exact same. You cannot use an agreement for an 8A for a small business regulation. Again, the regulations do not align one for one. They're close, but they do not align. So you want to make sure you're using the right regulation. I do have a couple more slides. I'm just going to keep going. If anyone has to hop, I fully understand. So joint venture performance of work compliance. This is probably one of the biggest questions that I get asked on a pretty much daily basis. So the joint venture, it has two separate performance of work requirements. So first is what I will call the external performance of work requirements. Really, this is the limitations on subcontracting. So for any set-aside contract, the joint venture has to perform the applicable percentage: 15% for general construction, 25% specialty trade, 50% services. This is measured on a dollars received from the government. That additional percentage, so the 85, 75, 50, can be subcontracted to any company. A joint venture can use a similarly situated subcontractor to meet the limitations on subcontracting requirement. Into figuring out the percentage of work performed by the joint venture, you combine the work from each joint venture partner. And if the partner venture happens to have any affiliates that's performing work, that would count as well. And then any similarly situated subcontractors. That collective percentage has to be at least the 15, 25, or 50, depending on the NACE code. Then from there, the joint venture has an internal performance of work requirement, meaning the qualified members of the joint venture have to perform at least 40% of the work performed by the joint venture. So if the joint venture has no subcontractors, then the qualifying party has to perform 40%. If the joint venture has subcontractors, then the percentage of overall contract work that's performed by the JV partners will then necessarily reduce the overall percentage of the contract that the qualifying members perform. But it's not 40% of the overall contract to the extent you have subcontractors. You look at the total amount that the joint venture is performing. Of that work, 40% has to be done by the qualifying partner. And the qualifying partner cannot use similarly situated subcontractors to meet this performance requirement. Both requirements, limitations on subcontracting and the 40-60 type split, are determined on a contract period by contract period basis. So this means if you have like a traditional 1-year base for 1-year options, you're complying on an annual basis. You're complying during the base period and every single option period. It is not the life of the contract. You can't just, quote, make it up in future years. You need to be complying on a contract period by contract period basis. The caveat there is for IDIQ contracts. If it's an IDIQ contract where multiple agencies can order work under the vehicle, then the period of performance or the period of compliance for each of these is the period of performance for the order. Otherwise, it's aggregated across all task orders, unless the contracting officer states that it's going to be measured on an order by order basis. Lastly, size and revenue considerations. So a big reason and a tool that you can use if you plan ahead for your size is you can actually use a joint venture to stay small longer. Reason being is because let's just assume you have an unpopulated JV doing services work. The revenue that the joint venture receives is split amongst the members commensurate with work performed. So in a prime sub relationship, the prime takes on 100% of the receipts. In the JV, that's not the case. If you have a joint venture that's awarded $10 million contract and the qualifying partner only performs 40%, you're taking on $4 million as opposed to $10 million if you were to prime it on your own. It is definitely a tool that can be used to try to stay small longer. You also want to make sure you're not double counting. So in that, for example, that $10 million contract, maybe you had some subs and maybe the managing partner performed $3 million, but that still equated to 40% of the work that the joint venture performed. The joint venture's total receipts, again, are the 10, but if the partner venture performed 40%, then the impact to their receipts is $4 million. However, if they've already performed 3, and 3 million of that is already accounted for in their tax returns, the net increase to the receipts is only the 1 million. So you take the difference, the 4 million less the 3 that they already accounted for. So you want to make sure you're not double counting when you have a joint venture. And then lastly, just profits. We get a lot of questions. To the extent the joint venture has profits, profits has to be split commensurate with the work performed, or where the managing member receives profits that exceed the percentage that it performed. I know that was a lot to run through in a quick period of time, but I will take a look to see if we have some other questions. And I appreciate everyone's time today. And again, if you have any questions that I didn't get to, or you didn't ask here, feel free to reach out, and I'm happy to get back to you. Okay, one question on the performance of work requirements. Can you please further clarify? Does the JV managing partner have to perform 50% and the remaining 50% is split between the partner and the other subs? No. So the joint venture first needs to comply with the limitations on subcontracting. And the joint venture complies by looking at the managing partner and the partner venture, the two partners to the JV. That percentage collectively has to be, let's say for services, has to be at least 50%. The remaining 50% can be subcontracted out. Whatever percentage the joint venture performs, let's say it's 50%, then the managing venture has to perform 40% of that 50%. There will be a recording available, I believe, on our YouTube channel and potentially elsewhere. But yes, there will be a recording available. Can we have an additional question? Can we have a teaming / subcontracting in parallel with the JV with the same mentor and protege? So, I mean, yes, you can have a mentor and protege can form both a prime sub relationship and a joint venture, but you wouldn't do that necessarily on the same project. You could do that on different procurements. Another question, does an 8A's joint venture's use of a NACE code count a corporation's limitation on NACE code use? For example, an 8A subsidiary. Oh, I understand. I think you're asking about the NACE code for entity-owned 8A participants. No, the 8A joint venture is not considered an 8A participant, so that doesn't have anything to do with the entity-owned NACE code 2-year consideration. Let's see, another question. How much help can a mentor provide to a protege on proposals? Well, I mean, my first question would be, does your mentor-protege agreement provide that the mentor is going to assist with proposal writing? The protege really should be the one in control of the proposal and the submission process, similarly to how it would in a prime sub relationship. So in general, as long as it's part of the assistance, a mentor can assist, but no, it should absolutely not be just preparing the proposal, slapping it on the JV and saying, here, submit it. And really, because of the control for the joint venture, it really should be submitted by the protege on behalf of the joint venture as the managing partner. One last question is, what is the latest on FCL eligibility of JV members? I touched on this already, but it really depends who you ask. If you ask SBA, it depends on what the key requirements are for the contract. If you ask DCSA or other DoD partners, they may say the joint venture itself needs a clearance. It really depends on the specific facts and circumstances of the solicitation. The cleanest option would be to get the joint venture cleared if possible, but there may be ways around that depending. And I think that was all the questions. I appreciate you all attending and asking really good questions. If there's anything, like I said, I didn't get to, please feel free to email me. And thank you again.